Thank you. I'm Sandy Chadha, CEO of Supreme. We'll try and get through the slides as quick as possible so that we can leave as much time for Q&A as we can. This is our team. CFO Suzanne's on the call with me, and every category leader has a head. So Andrew, Mike, David, and James are all heads of their divisions. And that has always been the case. When a new division comes, we have a head that is responsible for that. Supreme is a fast-moving consumer goods business. We're involved in 5 main product categories: batteries, lighting, vaping, wellness, and the new division that we've started recently on our ELF class as consumer. We are a manufacturer, we're a licensee, we're a brand holder, and we're a distributor of various brands. And we manufacture right the way to sell online. And we, in many cases, own brands that we manufacture, and we manufacture right the way to the source of raw materials as well. What's different about Supreme and other companies is not the 4 product categories, that is quite unique as well, is the fact that we supply up to 40,000 outlets on this platform. And this platform has a very shared overhead base, which means that when we add a new product category, we'll be able to do it at a very low cost, which means we can be very disruptive. And then when we're manufacturing it too, we just have the manufacturing costs. All the other costs on this platform are taken care of. So for example, our warehouse distribution center, our sales team, our finance team are all shared. And it's very hard to give the net profit position per category, even though we can do sales and gross profit. One other thing that we like to do is add on businesses. So we like to buy businesses and put them into our platform. And a lot of the time we reduce their warehouse and their manufacturing and put it into ours. And then all of a sudden it goes into our platform and it actually grows because we're able to sell it to more and offer it to more companies at the same time. Another thing to note is that we are probably one of the most profitable part of most of our customer stores. So which means that we're just as important for the customer as the customer is for us. And we've got a very long track record of keeping on to our thousands of customers. And the only other time we actually lose them is if they go bankrupt or they don't pay us for whatever reason.
So what you're looking at here is the key investment highlights, the reasons that we think that Supreme is so special. Unrivaled business model is exactly what Sandy's just outlined there. The ability to add incremental products and customers and even categories into this business and service them from the existing bank of resources means that gross profit and net profit are sometimes very closely aligned. It's also an unrivaled business model because of the extensive distribution it has across the UK retail network. It has long-standing and very deeply entrenched relationships with lots of key retailers, discounters and grocers across the UK, which means that when we do add incremental products or product categories into our business, we have an immediate bank of customers upon which to potentially sell it to. So that again gives us definitely a flying start certainly against startup businesses or even competitors that might act in one of the kind of product spaces that we operate in. As Sandy said, we own a lot of the brands that we distribute. We also manufacture a lot of those brands or hold them exclusively under license. And what that gives us is control over supply chain and an ability to generate expanding gross margins, which helps from a profitability perspective. And that leads on to the strong financials, no less strong than the financials we're about to see for this 6-month period. But historically, the business has grown revenue year after year, grown EBITDA, and has been very cash generative along the way. One of its other key investment highlights is its M&A strategy. We've talked previously about Supreme's very strict criteria for M&A targets and consumer goods that we can sell down that existing established distribution channel to our existing customers, products that we can hopefully at some point in the future or immediately manufacture ourselves, that there is a brand that we can own and it can be serviced by our existing overhead base. And that goes back to this gross to net margin relationship. We have a number of recent M&A opportunities, targets that we have acquired, where we have a very proven success rate in acquiring the business at a very low multiple, bringing that in immediately into our platform and generating incremental and growing amounts of adjusted EBITDA, no less so than Cymex, which we acquired 18 months ago, and also Cut Size, which is a business we bought last year. They're just two of the kind of standout acquisitions we've done historically, where that strategy has really paid dividends. And then the final point is diversity. We operate in 5 independent product categories. We operate via several different buying and business models, be that importing from China, buying from Europe, it may be more localized buying, it's manufacturing, it's importing under license. So we're not overly reliant on one way of bringing product to market. We're not overly reliant on US dollar or euro. So that isn't a factor that massively risks the business. We don't overly rely on particular customers. We probably now more than ever have more of a propensity for vaping versus the other product categories. And that's something that we will look to rebalance via M&A in the short to medium term. But notably across the board and historically, the business has been very, very diverse. Okay, so in terms of financial highlights, this is a clean sweep across the board, really. All financial metrics are all in the right direction for this period. Revenue is up, absolute gross profit is up, EBITDA is up, and so too it carries on down the income statement. But they're not just up marginally. These are fairly seismic leaps from year to year. Revenue is up 60%, absolute gross profit up 57%, EBITDA is up 88% to £15 million. This company has nearly doubled its profitability year on year. And it's done that because it has grown revenue, as you can see there, an incremental £40 million of revenue. And that has come from varying different parts of the business. So from the new ELF opportunity, but also the incremental revenue that the M&A has generated, and also the organic underlying growth. The takeaway here is that every single one of our categories, all 5 of them without exception, have reported growth year on year, and all have reported an increased gross margin, which just means that the business is working harder and smarter than it has done ever done before. The dividend we've announced is almost double that of the previous year, and our adjusted net debt is down at £4.8 million, meaning it's 0.2 times the last 12 months EBITDA, so a very low leverage rating. So yeah, financial metrics are all very positive for this 6 months. We've also been very busy operationally. We have completed the fit out of ARC, and we've done that, as it says here, on time and on budget. ARC is our principal storage and distribution site for the group. It has enabled, as we alluded to when we signed the lease last year, it has enabled us to consolidate our warehousing, less touch points along the way, increased efficiencies. And the transition to the new facility was exceptionally smooth, and so operationally that has been an out-and-out success for us. We now have lifted the ceiling in terms of how far this business can grow in that existing bank of resource and overhead. We've also rolled out and scaled the ELF bar opportunity, which we'll come on and talk to in a little bit more detail, but that's included and involved customer onboarding and product testing. So, has had its challenges, but we have scaled that opportunity significantly in this period. Whilst we haven't acquired any businesses in the period, we've worked really hard to integrate the 3 businesses that we did acquire in the year before, and we've seen manufacturing and warehousing integration and consolidation take place, which will help to generate increasing level and rates of return in the future. And we've also worked really hard in terms of our vaping category and determining what we think are the correct suite of measures to help combat underage vaping. And again, Sandy will kind of go through this in more detail as we go through the presentation. So what does all that mean for kind of the short to medium term? Well, we are now 2 months into the second half of the year, and we are really pleased with how that has traded. Really, like the first half, we have exceeded all of our expectations, and hence the profit upgrade that we've announced this morning. You may be aware that until today, our expectation was that the business would generate between 28 and 30 million pounds of EBITDA for this financial year, and that compares to 19.3 million the year before. So already a significant uptick from the year before. That 28 to 30 has now been revised to 32 to 35, so a £4.5 million upgrade on the previous one. And we've done that really because for the first time we have a clear line of sight to the year end on our core business, but also on the ELF opportunity, which we have really showed caution on that ELF opportunity up until this point. But the initial customer onboarding and the rollout is now largely behind us, and we're seeing the real cyclical repeat purchasing patterns that we see elsewhere in our business, such that it's given us the confidence to really roll that forecast right to the end of the year. And that's what the largest part of the profit upgrade. We have also as well seen some incremental trading over and above what we had anticipated in our core business as well, right across the categories, largely driven by higher gross margins than we'd expected. And our overheads are also tracking slightly behind where we thought as well. So just efficiencies across the board, and together they've generated this £4.5 million upgrade. We'll wait to see what legislation, what the government announced in early December with regards to vaping legislation. The consultation ends on the 6th of December. We are relaxed and we are supportive of any measures that will help to eliminate underage vaping. We have been very clear on that right from the start. This business does not market or sell anything intentionally to young people. And as we navigate through that, the business will continue to deliver ongoing profit growth and is well positioned for future M&A and other opportunities that cross its path in the future.
Excellent. So vaping, it's our outstanding performer. This is where we have our own brands. So 88 Vape, Liberty Flights, Cut Size, Red Astaire. And this business is half the growth has become organically from our existing brands like 88 Vape and some of the contracts that we have. And the other half is come from M&A that we did last year that we're seeing now the full half year benefits. This is the area where we manufacture, is where we have the highest margin, and it's where the retailers are really embedded with our brands here. And this is our sort of core bread and butter product. You've got to remember 88 Vape is not a cool brand. It's not attracting young vapers. It is a middle-aged brand for mum and papas, really. It's a brand that we started in 2013. And it's a brand, if you look back for 2016, how it's just grown year on year, every year. The 88 Vape 10 ml bottles is in still late single or early double digit growth. So we are still growing our number of bottles that we produce every month. I'd like to move on more. If you have more questions on this later, I'm more than happy to answer them. The next slide is the branded distribution. This is a real typical example where we can take on a business that is annually 60 million in revenue, probably more, maybe more, and actually put it into our platform and have very little infrastructure to add to it, which means that the gross profit falls to the bottom line to net profit. We have put a lot of working capital into this, must be, around about £16 million mark. But at the end of the day, we still make a decent return, a low, late single or early double digit return. But a lot of that comes straight to the bottom line. This has now also helped us get access to selling more products into the likes of WH Smith Travel, where we're now selling Energizer batteries and Battle Bites and other products. And it also means that we are now dealing with some of the biggest and largest retailers in the country. And we are already in transition with some of these retailers to introduce a pod system in both Elf Bar and Lost Mary, so that if there was a legislation change away from disposables, we are already ready with the same space into a pod system. So that's all being done in the background. Moving on to legislation and the changes. Now, we haven't got a crystal ball. We don't know for sure what the government are going to do. But however, we have got some very good ideas. And some of the things that we are already doing ahead of the government announcement is what we believe the government will do. Move to simpler flavor names, move to more simpler packaging, move to not selling products or not being allowed to sell products near confectionery or sweets, moving it more to the alcohol aisles. We're also looking at rolling out bins, and we have rolled out over 1,000 bins for disposable vapes for the environment. And we're here together to target and stop, or try our best to stop, the underage vape. which is actually giving Supreme a pretty well, it's giving the industry a bad reputation just by a few individuals that are causing problems. You got to remember also in this area, there's a lot of illicit vape, especially in the disposable, and a lot of the teen vapors are not vaping products that are gone through this screening process and make sure that they are safe to vape. They're buying products that are illegal with more nicotine and more puffs, and potentially having more metals, heavy metals, and formaldehydes and cancer-related products that have been inserted in them. So it's important that we tackle as a country the illicit vape that are coming into the country. So moving to plain packaging is something you'll start seeing on our shelves in the early part of next year, hopefully ahead of the announcement. We're also very committed into the government changes and looking at all the options. And there is talks about a tax. We don't believe there will be a tax on vaping, only because the government are already giving these away to 1 million vapors free to stop. Giving 1 million vapes away to cigarette smokers to stop them from smoking cigarettes. But on the other hand, tax. So we don't believe that it will go down that route. However, even if it does, we think we're still in a very strong position to still maintain the sales that we have to our current vapors that buy from us already. Moving on to the wellness. The wellness side, again, another great year. And we started 4 years ago, and this business is just really motoring ahead. We're looking at a full year between 18 to 19 million in revenue. The Cymex brand that we bought is doing particularly well. It's embedded into our supermarkets and our discounters. And we've started to launch new products in that range, pre-energy drink. We've also launched other pre-workouts and post-workout products that we're working with some athletes at the moment. So this is the industry that we're still heavily invested in. We are looking for more M&A in this area, and we are targeting small, medium-sized businesses up to 30, 40, 50 million revenue that we can acquire and put them into our platform or into our manufacturing facility. Again, vitamins has had a little bit of a step up in the last few months. We are still having another go at it in terms of more marketing and a bit more advertising around some of the brands in this area. So overall, we believe there's still a lot of growth and there's a lot to be done in this area. And we believe that the future here is pretty good. Now that the raw material prices have settled and are now a lot more stable than they were this time last year. You can see that in our gross number and our sales as well. Lighting. So lighting, we had a fallback into 2023 to 15 million. You can see that now coming back, and we're hoping that the 20% growth will carry on. Will it get back to the 27? We're a little bit disappointed it's not got back further, to be fair. We haven't lost a single listing. We haven't lost a single space or retailer or brand. We've extended our licenses for another 7 years. Unfortunately, it's just the matter of the overstocking in the industry, and the industry itself has taken a little bit of a decline, which you've seen in our figures. But as you say, it has come back, and it will carry on coming back more towards us 27, but we're a long way off yet. However, we are confident that we can expand our international side of this with our Energizer brand in Europe and outside Europe. So we are hopeful to expand this in the international territories rather than the local ones where we believe that we've got quite a good listing and distribution network already in place. Batteries. So this is where we started the business, and this is where we gained tens of thousands of retailers, which we didn't know at the time has become the bedrock for us to sell hundreds of more products to the existing customers. We've always said batteries will range between 30 and 40 million. We believe we're going to beat 40 million this year in terms of revenue, which means we'll have over 30% of the UK battery market, which is really pretty dominating. And it means that 1 in 3 batteries that are sold potentially could come from Supreme. It's a cash cow. It always has been, and it's an area where we are still committed, and it still gives us a very good foot and a strong facing with the customer to talk about selling more products to them. So we believe this is still incremental to our business. It's important to our business, and we're still actually actively trying to grow this business, even though we believe that we're at a point where it's going to be harder to grow at this level. Moving on to the financial, Suzanne, over to you.
Yeah, thank you. Okay, so you're looking there at our income statement for the 6 months, and if you just cast your eye down the right-hand column, you can see that all of those metrics are reporting are in growth year on year. So revenue, gross profit, adjusted EBITDA, all the way down to PBT, and even EPS is more than doubled as well. So an outstanding kind of financial performance. If we just flick forward onto the revenue bridge, it's just one more, Hannah. I think this is easy to actually illustrate how revenue has grown. So it's gone from 64 million up to 105, so 40 million pound growth. 26 million of that has come from the new distribution arrangement with Elf Bar. We've seen the impact of the M&A that we had completed last year. We take full year effect, so 5 million of that growth comes from M&A. Then the remainder comes from the core business. So organic growth in vaping is another 5, and then the other divisions have contributed. So wellness, lighting, and batteries have contributed a further 4 million. So all elements of the business have played their part. The M&A has also ensured that that has secured continued growth for us as well. So yeah, it's right across the board. And then if we flick down one more onto the gross profit bridge, this again also illustrates that growth in gross profit comes again from all categories, all categories within the business. So whilst our overall blended gross margin has gone from 28% to 27%, which would indicate that something isn't quite as cost effective as it was, that's really a result of sales mix. So we've added the Elf opportunity into the group, and because that as a margin is much lower than our core categories, because we don't manufacture it, we don't own the brands, then that has had a slight dilutive impact. But actually what's going on in that gross profit is that all the other categories have expanded their margins, and we've just had the addition of Elf. So you can see there that Elf has contributed 2.8 million of incremental gross profit. We've had better margins across the board, contributing a further 2.7. We've had the impact of last year's M&A coming in 2.2, and then we've got the general growth in sales and volume that has also helped to drive incremental absolute gross profit. So all areas contributing, and that's delivered this 57% growth in gross profit year on year. If we then flick forward again onto the balance sheet, you'll see here that for this period, the balance sheet has strengthened even further. We can see that our total net assets are now up at our fixed assets are up at 36 million, which reflects the investment in our ARC warehousing facility. Our investment in working capital overall looks fairly modest. We've gone from 25 million this time last year to 30 million. But actually what you don't see there is that is a 16 million pound investment in Elf, and the remainder of the business really tightening up and moderating their own working capital requirements to compensate. So that just goes back to kind of the real foundations that Supreme is built on, which is that costs and cash remain under really, really tight control continually. You'll see there that the net debt position is reported as 19.8, but that's inclusive of the IFRS 16 leases. Actually, it's just 4.8 million. And if we flick over onto the cash flow, you'll see here that we had a net cash outflow in the period of 2.7 million. However, the second number from the top is 16.4 million, the working capital investment. Had we not invested in Elf, then the business there would have generated nearly 17 million more pounds from just purely from operations, which is just showing that our operating profit is really dropping straight down into cash had it not been for the investment in growth for Elf. We've continued to service, obviously, our corporation tax obligations. We have had deferred considerations for the M&A we did last year. We fit out ARC, and we've also paid our dividend. What we expect to see in the second half, however, now that the investment in Elf is behind us, is that actually that Elf opportunity will now just start, and has already started, to just throw off cash because the investment in working capital is done. If the Elf opportunity increases further, there'll be continued investment in working capital. But actually, if the Elf investment if the ELF opportunity reduces for whatever reason, maybe regulation has something to play in that, whilst as ELF reduces, obviously that working capital will unwind and that will generate incremental amounts of cash as well. So business continues to be cash generative overall for the year, but we've seen an investment in this first half. So all in all, how do we conclude? We've had a phenomenal first half from a financial reporting and trading perspective. Revenue, gross profit, net profit, EBIT, all of those elements are up, and every person in our business, every category within the business has played its part. All of that has driven a further upgrade in profit, which if we just keep the kind of prior year, full year number, that 19.3 million in the back of your mind, actually the growth year on year is almost touching double for the full year potential, which is we're really excited about. The business, Supreme has been around a long time. It's extremely resilient and very agile. So whatever is thrown at us vis-a-vis regulation, Supreme is well versed and experienced in managing that, and therefore ideally positioned to continue to deliver growth.
Can you quantify what a ban on disposable vaping represents on your revenue and profits?
No, it's a short answer. So what I can tell you, so I think you'll have seen if you've read the RNS cover to cover that we have reported £34 million of revenue in respect of disposable vapes for the first half. So that is largely the ELF opportunity, but then you'll know that we also have a range of disposables in our owned brands as well. I would expect that that's generated in total around 3 to 4 million of gross profit, but we don't measure EBITDA at a product level or even at a category level for all the reasons Sandy said at the start. So we can make an estimate and say that, let's say that that's cost us 20% of that revenue of that GP to service it in overheads, but we really would be guessing. I suspect the reason for the question is because what someone's getting at is if disposables are banned, what would be the potential loss? And that's very different to the answer to the question of what profit is disposable vapes generating, because the regulatory change wouldn't necessarily spell out that the entire revenue stream would disappear. What we actually expect is a more likely outcome is that there will be a significant transition of those disposable vapors onto an alternative form of vaping. So then the actual net loss to Supreme would be much more marginal than just taking that entire revenue stream and removing it completely from the group.
I mean, just adding to Suzanne, vapers today have got choices. Adult vapers have got choices if there is a ban on disposables or if disposables are no longer available in the format they buy them in. They've got choices of actually going on to an alternative. Maybe it's fewer flavors, but an alternative. They've got a chance of moving on to 10 ml, which is our hero product, which is also a lot cheaper. Or they've got a chance to move back to cigarettes or give up cold turkey. And we believe that there will be an element of some will go back to cigarettes, some will go cold turkey, but we believe the majority will move to an alternative in vaping rather than the other three. So it's very hard to quantify what it does. But one statistic I'll tell you is that if disposables, worst case scenario, were banned and no one moved on to anything else, we'd have a mountain of cash that we have already invested in disposables, and with the profits that we're going to make now and that we have made, to reinvest in more businesses and to bring back a lot of the lost earnings. But we don't believe it's going to be that. We believe there's going to be a transition into alternative methods of nicotine delivery.
Thank you. When did the ELF bar Lost Mary distribution opportunity operationally commence? We know it was announced on the 5th of July, but...
Yeah, about May, June.
Right. But the 26.4 million in less than 3 months seems inconsistent with full year guidance of 60.
You got to remember there's a rollout period where a lot of retailers are taking in inbound stocks and filling their shelves. So you got to take that in consideration. And Suzanne, anything to add to that?
Yeah, no, I was going to say exactly the same. It pipe fill. Initially, a customer may take 2-3 months worth of stock, which then sits in its own distribution in its network on an ongoing basis, and then just order on a kind of replenishment basis thereafter. So we've had the benefit of all those initial pipe fill and rollouts. Now we're just in a kind of business as usual pattern, which is we expect to continue to the year end.
Okay, we'll stick with vapes for now. Can you give a sense of the split in gross margin between e-liquids and disposables on your own brand? This is.
I mean,
Go on.
I don't know if you specifically say, but it's nearly double, isn't it? Would you say?
Yeah, so we don't tend to break down gross margin within a category. We tend to report gross margin as a blended gross margin for the entire category. What we can tell you is that the margins on manufacturing are obviously much higher than anything that we've imported, in fact more than double. And because of the propensity and the volume that we do in manufacturing, that much more heavily dictates the overall margin that we make in vaping. So manufactured elements, north of 50%, but our blended margin is still in the kind of mid 40s, and that's because so much of the category is manufactured. The disposables is still really on the periphery for our core vaping category.
Okay, thanks. Is ELF taking the same preemptive steps regarding packaging, flavors, etc., that Supreme is with 88 Vape?
I think that they are putting out recycling bins into thousands of retailers. We're doing that collectively in some of the retailers now. They're actually pretty good. They've got a good voice in that area now, and they are definitely actively working towards much better understanding of what they're trying to do in terms of stop children from vaping.
Okay, thank you. Moving on to some of the other segments, the new Cymex products are excellent. See somebody enjoying them here. The Explode Drink and Mass Protein are delicious. Will you try to place in stores or focus on building via direct consumer on the Cymex website?
No, I think it'd be both. I think the cans that you're talking to, and they're in B&M now, and they're doing pretty well. I think that there's a combination of both. I think we're going to definitely expand our e-commerce offering, have more flavors, more choice online. But our retail is our main our main sales and our main sort of distribution, really. So we can't ignore that.
Okay, thank you. Can you elaborate on the efficiency gains due to the new warehouse? And are you happy to put a figure on these gains?
We haven't put a figure on them so far. We perhaps might revisit that at year end once we've had some more time and we've seen kind of business as usual patterns emerging out of the facility. We only moved in July, so it's still very early doors. What we do know for sure is that we've consolidated our warehousing operation, so we now have less physical warehouses than we did. We're processing more orders than we ever have done before, because of course we've now put Liberty Flights in there and Super Dragon, which was the entity that we acquired right at the end of the previous year, and we haven't invested significantly in any further resource to support that. So we're certainly more efficient. How more efficient, and putting a financial metric on that, we haven't done that as yet. Like I said, perhaps we'll cover that at year end.
Okay. Aside from vaping, which divisions do you feel have the biggest growth opportunity over the next 3 to 5 years, and why?
Yeah, so it's got to be the wellness side. It's got to be the second after vaping. Why? Because there's a lot of medium-sized businesses, 10, 20, 30, 40 million that are not making any money that we can probably buy. Interest rates have never been higher. So there is a squeeze now on a lot of businesses. They're not making as much profit or making losses even. Which means that we'll be able to start looking at buying businesses, whether they're manufacturers, whether they're brands, whether they are selling all the different types of products in the wellness, and we're looking at buying those businesses. That will supercharge. And we can write a check today for nearly 50 million today if we wanted to buy a business without going to the banks for any more money.
Thanks. As a management team, you seem to have capital allocation at the forefront of your mind. However, there is a reluctance to do share buybacks. Is that because your focus is more on growing operating cash flow as opposed to EPS? And if you did a buyback via a tender, Sandy's holding would reduce pro rata with the shares outstanding, his percentage held would be constant.
So if we buy shares back, as a company buys them back, I think my shareholding will go up rather than go down because there's less in circulation. I think it's got it the wrong way around. So I've already got nearly 57%. And if we do a share buyback, it'll take me to 65. And we get to a point where there's less liquidity in the market. So it doesn't make sense to go down that route, even though we have the cash. It's probably better to do a special dividend and give that back if we don't find M&A. My first preference is M&A. If we don't find an M&A that's suitable and it's not right, we can give some of the surplus cash back if we wanted to. We can revisit this at year end.
Yeah, and an opposite perspective from a different investor, between directors and a few major shareholders, there is very little stock available to purchase.
Yeah.
If this is the case, What value do you feel you get from having a stock market listing?
Yeah, so a really good question. The reason we went on the stock market was so that we could raise some of this equity that we've got, I've got, to actually raise to grow the business further. But what happened with markets, UK markets, is dire at the moment in terms of valuations. It wouldn't make any sense for me or to anyone to sell down some shares or reduce shares to raise money. And that was one of the reasons to coming as a public company. And obviously, at the moment, that's not a viable solution. However, there is still advantages of being a public company. We are able to attract some really good employees. We were able to give them share options. I mean, we're giving them share options now at a rate that we believe that they should benefit in the next 2 years. So there is advantages, but it's a really good question, and unfortunately, it's because of the markets have changed. Suzanne, is there anything to add on to there? Would you say?
I'd say that as we were pitching for the tender with ELF, the fact that we were a PLC definitely carried some weight from a kind of credibility perspective. And I think it's definitely something that we roll out as part of our presentations and our tenders with other customers as well. I think being a PLC gives you that kind of rubber stamp, and that's important when you're trying to win new work. So I think it's multifaceted, the benefits that we do see. Yes, they've not been as extensive as we might have envisaged kind of 2.5 years ago when we floated, but we just need to be patient, I think.
And longer term, you're committed to remaining listed?
Yeah, there's no changes about any of that. We're committed on markets today. In fact, I think I bought a little bit of shares back, but nothing substantial. Only just I just felt there was good value at the time. I just think that we are committed for being public markets at the moment. I said that last call, and nothing has changed.
Thank you. Just on the fact that you are a listed PLC, doesn't mean you have to hold an AGM. And what's the rationale for holding it at 8 o'clock in the morning? Because some people would like to attend.
Okay, so a couple of things. One is we started our board meeting at 9, so we like to get out of the way before the board meeting. Look, if it's a concern and people want to come, I'm sure that we can look at that as something that we need to discuss. And also, at the same time, there's an email investor. Just email. We're going to reply back to you very quickly on any questions that you have. So if you want to come to attend, suppose you don't want to see our faces, you're coming there because you want to know more about the business, please just go on the form and just email us, and we'll reply back to you, or we'll come back to you if we can with the information, if we're allowed to.
Of course, you're always able to ask questions in a forum like this. Current pipeline of M&A opportunities. I know you've touched on already that wellness is a big opportunity. Is there anything in the near term, and can you give us a sense of any opportunities regarding their size and pricing?
Obviously, this is all confidential in terms of where we are with stuff, but what I can say is that we're actively seeking, and I've got many NDAs signed with many information memorandums on my desk.
Sandy, you mentioned that recycling bins are being placed at sales outlets for used disposable vapes. Who would pay for the collection and recycling? And does Supreme have a contract in place for this specialist recycling? If so, what does it cost?
Yeah, so we're a battery distributor. So part of our battery legislation is that we've got to be part of a compliance scheme, and we've got to help collect batteries. So we're already well positioned. So when vaping came into this, it's like, well, we know exactly what we're doing because we're doing it already for batteries. Because that's the only reason you collect a vape back is for the battery inside it. And yes, we are got bins out in thousands of stores. And yes, Supreme, we will pay for that. It's something like £1.2 million a year we're paying already for collection of batteries. I don't see that going up significantly with vapes, because a lot of it is collected at the same time as we're collecting our normal AA batteries.
Okay, thank you. This question says, do you have any volume KPIs? They don't say which sector they're referring to, but let's start with vaping.
Never really volume. Do we? I mean,
we do in manufacturing. We measure the number of bottles every single day that we manufacture, and the number of pouches that in wellness, and the number of vitamins potted every single day. So that's an email that goes out to management every single morning. Aside, we don't actively monitor number of orders picked or number of orders placed. It's more kind of on a sales value perspective, but manufacturing, it's very volume based.
Okay, thank you. couple of days ago, I visited the vitamins website and most items were sold out. Could you comment on that, please?
Yeah, so we're just waiting for replenishment stuff to come on. Sea lions, I think, referring to. I think in the next couple of weeks it will be sorted out. There was a quite a big rush before Black Friday as well. So yeah, we hopefully have a lot more availability in the next few weeks.
This investor talks about their commitment to investing not only in good businesses, but also good business practices and how people treat their staff and employees. How do you shield your employees from discrimination? What HR policies have you got in place to make sure you live up to your commitment in people?
Most of our senior employees today come from the most junior positions. Our retention to staff and people is probably the best in the industry. We've got people been in the company 10, 20, 30 years. And in terms of our belief is, or my belief is that we should treat everybody with the same respect, regardless of the position. And in terms of actually, it's actually HR specifics, I guess, you know, we've got our policies in place that we don't really want to go into, yeah. But we're very fair, I believe, as a company.
And in our annual report that we published back in, that's now on our website from August, there's a big section in kind of on our employee policies in there in terms of, we went through an initiative called the Employee Journey last year, where we looked at how we onboard, how we train, how we incentivize all of our people, as Sandy said, regardless of level, and there's quite a lot of detail in there. We have a very open book kind of communication policy, a very transparent pay grade policy. So I don't think anything that you wouldn't expect to see of a public company.
Lovely, thank you. Do you have any European expansion plans?
Yeah, so Europe's always been interesting for us, and we are launching a website similar to our UK one, where Europeans, they specifically target for European websites, and we're going to start targeting AdWords. This is a business-to-business trade website in Europe, and the UK website does about £1.3 million every month in sales, and that's just UK. So we're just launching that now. We're in test mode at the moment.
Great, thank you very much. That's it for the questions today. Thank you all for attending and listening in, for such great questions, and thank you both, Sandy and Suzanne, for taking the time to join us. We'll look forward to catching up in another 6 months' time.
Thank you.
Thank you.
Bye-bye.